Welcome back to Investment 360. The significant flow of retail investment money into unit trusts that provide portfolios spread amongst different asset classes in South Africa in recent times has been phenomenal. But can multi-asset unit trusts outperform multi-asset portfolios using passive exchange-traded products? Mike Brown, Managing Director from ETFSA.co.za, joins us now to discuss this. And obviously, Mike, you're going to say yes to that question.
That's great. Unit trusts are they're multi-managed portfolios by putting together different types of asset classes, but relying on active managers to provide the performance of the different buckets and asset classes. Now, you can replicate that by just doing it through exchange-traded funds, which give you access to, say, international equities, local equities, bonds, commodities, and other asset classes. Now, the benefits of doing it just using passive products to do multi-manager asset allocation is that the costs are lower and that you're getting the exact performance of the benchmark by buying an index tracking unit trust or an index tracking ETF. And so most studies indicate, and I did a study just recently in South Africa, that said that if you actually replicated the unit trusts, multi-manager, high equity unit trust portfolios, and you just put those into ETFs, they would outperform, not so much in year one, but year 3 and year 5. The further out you go, the more the outperformance happens. That indicates two things: that costs matter, because the low costs obviously don't erode performance, and secondly, that you can get more consistent performance from the different asset classes by just using passive management.
Mike, the big trick with the balanced funds in the active managed side, and obviously the ETFs, is that the active managers move those allocations between equity, bonds, cash, property, according to the type of market environment they feel they're in and the ones that will give them the best returns. So most people who own a balanced fund, that manager has the ability to go up to 75% in equities. When these issuers and product providers build the ETFs, they've got to set the different limits according to how much equities they want to keep, and there's no ability to float and adjust those different allocations in a passive product. So how easy is it to compare a passive multi-balanced portfolio with a balanced fund like run
I mean, what you're talking about now is something like ABSA, which has a fixed asset allocation. They've got the MAPS products. There's a growth product and there's a protect product, and that has a fixed, it has 45% in equity in the protect product and 75% in the growth product. But you can replicate that by just buying ETFs and doing your own asset allocation. That's what I'm really talking about, is that you go out there and say, well, I'll take, because your active manager, whoever's managing those multi-manager funds, is taking an active asset allocation stance. You're saying, well, I'll move between different types of asset classes.
So you say diversify amongst the ETFs.
Yes, yeah.
That's the bottom line.
Yeah. So the passive, what you do is using passive products to give you access to asset classes, but then you're using active portfolio management to decide how you move amongst the different asset allocation. Now, as I mean, many of your readers or your listeners would know, there's a lot of studies that indicate 90% of performance in a long-term portfolio is just getting the asset allocation right. It isn't selecting which shares to be in that. It's just saying, when should I be in the different types of asset classes?
Right.
And you can do that using passive portfolios as well as using active portfolios. Passive portfolios, lower cost and much quicker to change, because these things are completely liquid. You can switch instantly from one asset class to another without often in a big active management portfolio. The guy's got to now sell the shares, and that sometimes takes a while, and then buy the shares. You just do it instantly if it's ETFs. I mean, they just trade on the stock market. So switches can be, instantaneous.
Very easy to do, obviously, but a lot of I think a lot of the savings or the money that goes into these balanced products is what we call that Regulation 28 compliance, so that people can put it in their pension or their preservation fund or their retirement annuity. Are there vehicles for people to do that with their own, where they can make the decision themselves, but use it in a retirement-friendly product?
At this stage, to do in a retirement-friendly product, you've got to have a license to run a retirement product. Now, ETFSA has just launched some retirement annuity funds just very recently, where we actually, all the investments are in ETFs or exchange-traded notes, and then we just have an asset manager who makes the asset allocation decisions, but it's Regulation 28 at all times, and because it's completely transparent, you can look at that portfolio on daily, or you can look at it every minute if you want to, and it'll be Regulation 28 compliant all the time. So you can do portfolios using ETFs just like you can do portfolios using active management blocks as unit trusts. The benefits are much lower costs and more consistency of performance. Now, in a long-term portfolio like a retirement annuity, you want both of those. They're very important.
How do we compare to the US, who has a very big retail base when it comes to investing? Do they use passive investing extensively?
Yes, increasingly. That's the same thing that came out in the retirement fund reform papers that have just come out from National Treasury. They say we can't understand why people don't use passive portfolios for long-term retirement funds. And the reason is all the information they're getting internationally says, well, if you really want to get good performance and consistency of performance over time, just use passive products in your retirement annuity products or funds. So, in fact, there's movement towards that in South Africa. There are a couple of people doing this. ETFSA is one of them. And we're finding a tremendous amount of interest because people are saying, well, perhaps these other retirement funds are just too expensive and too complicated. And there's penalties and there's loyalty clauses and there's performance fees. I don't want that. I just want a simple thing that, that gives me access to a Regulation 28 compliant portfolio at relatively low cost with complete transparency. You can do that in passive portfolios.
We've actually seen, Mike, looking overseas, we're watching what US stock brokerages have done, and they actually use the ETFs as a bit of a loss leader, where they let people buy ETFs and keep them at a very low cost in their broking account because they know that will be a long-term base to keep a client with, and then obviously they can sell them a whole lot of other products there. Do you think we might see that in the near future here?
A little bit of that, yes. I mean, most stockbrokers would rather sell you a whole bunch of shares than just sell you one ETF. Because if they sell you the underlying shares, they make brokerage in all those underlying shares. They sell you an ETF, they just make brokerage once. So they typically won't do that. But yes, if you want exposure to the market cheaply, the best way to do it is buy an ETF, whether it's buying bonds or buying equities or buying a certain type of asset class. So I think that what happens internationally happens in South Africa eventually. So I think that's the one issue. The second one is I'm not decrying people using unit trusts in RA portfolios. I'm just saying look at ETFs as another possibility. So you can use index tracking ETFs or you can use actively managed unit trusts in retirement fund portfolios. But that's the sort of product you should be looking at. Don't look at these old-fashioned retirement annuity funds that have got life insurance policies wrapped into them and all sorts of other things, the old generation stuff. The new generation products are much more visible, much more transparent, and you can get into them and stop your contributions. That's part of the real world. You're going to lose your job and you maybe can't contribute to your retirement fund for a year or two. Well, you shouldn't be penalised for doing that.
Just one thing I noticed, I think within the Absa Maps and Protect and some of the other products that we've seen come out in the RA format or for multi-asset class portfolios, is there a component for the foreign and offshore exposure? Because we've obviously seen South Africans' heightened concern around their investments in real dollar terms, I guess. Have any of those portfolios brought into components that invest offshore as well? So you've got the whole range of the basket.
That's another good question because MAPS doesn't do that. But I know there's one or two products just on the horizon that are going to be listed quite soon, which will be ETFs that give you balanced portfolios using offshore. So that can happen. But if you buy the ETFSA RA fund, we just use the DBX trackers for the offshore exposure. And we use, I think there's a bit of commodities in there as well. There's a bit of gold and a bit of oil and some softs in there. So there's about 6%, I think, some commodities. We just use ETFs to give you that exposure. So we can pick any ETF and put that together in a portfolio. The sort of products which they have a more fixed asset allocation at this stage, those offshore products are not in there, but it's just a matter of time. It's it's probably a few weeks before we start seeing that listed on the JSE.